Charitable giving actually is one of the few places in financial planning where doing the right thing and the smart thing actually are exactly the same. Hello, welcome to Financial Wisdom with Milan. My name is Milan. Today actually the topic is going to be charitable giving. Why? We'll explain that. And also, does it benefit us just because we give? Well, we're Americans. Of course, we should figure out a way to benefit us, right? Can we just give without any expectation? I think we can, but let's address a few things here actually, which is really important. So I will show you how to. Thank you for joining us today. Most people think that charitable giving is simple. You write a check, you feel good, you go home, right? But here's what most people don't know. There are at least 7 other ways to give that are potentially more powerful, more tax efficient, of course more meaningful than writing a check. And some of them cost you absolutely nothing, but just your time. Hello, my name is Milan Prashtal. I'm an independent financial advisor, and today I'm going to walk you actually through everything you need to know about the charitable giving, whether you're looking to reduce your tax bill, leave a legacy, or simply help your community. This is the most complete guide to charitable giving you'll find anywhere. Naturally, if you like the content, please subscribe or like it or don't like it, it's fine too, okay? Thank you. And before we get into strategies, actually, the link to grab this free checklist is in the description. Download it now and just basically follow along. It's going to be pretty straightforward. So before we actually get into the strategies, I want to give you some context, okay? Because this isn't just about our taxes, obviously. It's the right thing to say and do. It's about the impact. And when you understand how the math works, you can actually do more good with the same dollars. I mean, think about this. Americans donate roughly $500 billion per year. We're the most generous nation on earth. But most people are giving basically the least efficient way possible. So that's why we're doing this. Here's what changed. Back in 2018, the standard deduction nearly doubled. That means that most Americans actually no longer itemize their deductions, which means millions of people are writing checks to charity every year and getting absolutely zero tax benefit from it. That's the truth. We're going to fix that today. Why? Because this is Financial Wisdom with Milan. Because for those actually who do give strategically, the IRS literally rewards generosity. How? What are you talking about? Well, we're talking about hundreds or even thousands of dollars in savings from the exact same dollars you're already giving. But before we get into the how, I want to give you the why. Money is just like the vehicle, What we're actually really talking about is impact, legacy, connection to something bigger than ourselves. I think it's the right thing to do anyway. Let me share a quick story. I had a client, I'll call her Carol, and she's been donating about $15,000 a year to her church and 2 local charities for the past decade. She always wrote a check in December, end of the year. And every year she got to feel good about it because that was it, right? When we sat down actually and looked at her financial picture, I showed her that by simply changing how, the key word, she donated, not how much, she could actually save over $3,000 in federal taxes this year alone. Same generosity, same impact, $3,000 extra dollars back in her pocket, which she loved. That is what this video is about. Okay, so here are actually the 7 ways to contribute that go way beyond writing a check. I'm going to spend a little time on each one, and I'll tell you exactly what who each strategy is designed for. Well, method number 1, donate appreciated stock. Why? Who's this for? Well, anyone actually who owns a stock, mutual fund or exchange traded funds that have gone up in value, obviously. Here's what you do. Instead of selling the stock, paying the capital gains tax, and then donating after-tax cash, you transfer the shares directly to the charity. Now, why is this so powerful, Milan? Well, you avoid the capital gains tax on appreciation, obviously, number 1, and you get to deduct the full fair market value. That's a double tax benefit in a single move. Here's an example. Say you bought a $5,000 worth of stock, right? That is now worth $20,000. If you sell it first, you owe the taxes on that $15,000 worth of gains, right? And if you donate it directly, zero. You pay zero capital gains. And you deduct the full $20,000. The single strategy, donating appreciated stock instead of cash, is the number 1 actually change that I recommend to almost every client who invests and gives to charity. It is that impactful. It really is. Method number 2, the Don't Advise Fund, or DAF. Think of it like a charitable savings account. You basically deposit the money, get a tax deduction immediately, which is a good thing, right? And then grant it out to the charities on your own timeline, this year, next year, or even in 10 years. The key benefit? You can contribute in a high income year to maximize your deduction, then spread the grants over several years. For example, where do you open one? Well, Fidelity Charitable, Schwab Charitable, Vanguard Charitable, with minimum as low as $50 to $5,000 actually. I'm going to go much deeper on DAFs in a few minutes because this is the single most powerful and underused giving tool in America actually. So, method number 3, volunteer your time. Well, basically, who is this for? Well, I mean, it's simple. Everyone actually, really. I mean, there's no BS here, but seriously. But especially people who have more time than money right now, or those who want a deeper personal connection to their cause. On the tax side, actually, your time itself isn't directly deductible. Hey, thanks, IRS. But out-of-pocket expenses are. And mileage driven for charity is deductible at 14 cents, I think it used to be, per mile in 2024. I think that's what it was. But the real value actually volunteering goes beyond taxes. One committed volunteer can do more for a nonprofit than 10 one-time donors. Your skills, your consistency, and your presence are irreplaceable. That's just a fact. I just want to start with a little story about myself before I continue to number 4. So when I came to the States in 1996, actually within a year, I think, as I started in this business, I actually started volunteering myself because I didn't have the money, I couldn't contribute that way. But I was actually a mentor to a couple different boys and girls actually downtown. And I wish I can tell you it was a waste of time. It was one of the most satisfying things I ever done in my life. It really was. And I'm so glad they allowed me to do so. Particularly, I took them to the office to show them around a little bit, went to the Yankees game, and just get to hear their stories, what they struggle with, particularly the younger folks that needed help at the time. So I'm forever grateful, and I'm so glad that I did what I did, actually. And basically, we're still friends, right? That's the whole idea. We helped, we made the difference. That's what counts. So the method number 4, teach and educate, right? This one is especially relevant for financial professionals, educators, and anyone who actually who's actually with expertise watching this video. If you have expertise, why not? What does this look like in practice? Well, financial literacy workshops at schools or libraries, one-on-one budget coaching, mentoring a young person, speaking at a community event. And here is the impact multiplier. Teach one person to manage their money, and that knowledge ripples through their family, their children, and their grandchildren. I know this from experience, okay? And I'll be honest, as a financial advisor, I mean, teaching is one of the most meaningful things I do. I mean, that's why one of the reasons I'm doing this. It's part of why I make these videos, actually. The knowledge gap around personal finance is real, and you can be the person who closes it for someone. And more importantly, we don't have to wonder if our kids are going to do it the right way, or grandkids. If you teach them, you spend time and invest with them, or with them, him or her, and them, absolutely. So we have number 5. We call it in-kind donations. It is that simple. I mean, this means basically donating goods instead of cash. I mean, food. Makes sense, right? Clothing, furniture, equipment, vehicles even. You can deduct the fair market value of donated items as long as you get a receipt from the charity. Don't forget the receipt, please. Your advisor told you, so that makes a lot of sense, okay? Now, for the business owners, actually, donating inventory or equipment you were already planning to write off can be a smart double benefit. Talk to your CPA about the IRS Section 170, I think it's called, for specifics. They'll explain to you why and how, and you certainly can. My clients have done it. I'm sure you can too. Method number 6, actually, this one is specifically for the retirees. It's very popular with my clients because most of my clients are 50 plus, especially qualified charitable distribution, or QCD. Basically, if you have an IRA and you're age 17 and a half or older, listen carefully, because this actually may be the most important thing in this entire video for you, honestly, because it's beneficial. A QCD allows you actually to direct a distribution from your IRA straight to a qualified charity up to $105,000 for 2024, if I'm not mistaken. That is correct. Please correct me if I'm wrong, but I think it's $105,000. Now, here's why this is incredible. The money actually never hits your taxable income because it's transferred to charity, obviously. You don't even need to itemize. You don't. And it counts towards your required minimum distribution. Yeah. And if you're, like I said, over 70 and a half, have an IRA and you give to charity and you're not using a QCD, snap out of it, okay? You need to call your financial advisor this week, seriously. This could save you thousands of dollars per year. Very, very important. And the method number 7, charitable trusts and bequests. Charitable trust and bequests. The simplest version, basically, bequest in your will. Name a charity as a beneficiary of your estate or a specific account. It costs nothing to set up and leaves a lasting legacy, okay? Now, if you want to do something a little bit more advanced, you certainly can. A charitable remainder trust, it's called a CRT. Lets you basically transfer appreciated assets, receive an income stream for life, and leave the remainder to charity. I'll explain in detail in just a few minutes, of course, just like with the DAF. From an estate planning standpoint, charitable gifts can also reduce the taxable value of your estate, which matters a great deal, particularly for the high net worth families. Yeah, kind of makes sense, doesn't it? So basically, I just want to spend a few extra minutes on a donor-advised funds, because I genuinely believe this is the most powerful charitable tool that most Americans actually have never heard of. And once you see how it works, you'll wonder why nobody told you sooner. Okay? Going back here to number 2. Let me walk you through a specific example without the donor-advised funds. For example, you give $6,000 per year to a charity. Your standard deduction as a married couple is $29,200. Since $6,000 is well below that, you take the standard deduction, right? And you get zero additional tax benefit from your charitable giving. Your generosity is real, yeah, but the tax savings, zero. Now, with the donor-advised funds and a bunching strategy, let's bunch this together. In year one, basically, you contribute, for example, $18,000 to your DAF, to donor-advised funds. That is 3 years basically worth of giving all at once. Now you have $18,000 in your charitable deductions. And when you add your other deductions, you're actually well above the standard deduction threshold. You itemize and you deduct the full $18,000. Makes sense, right? Now in the years 2 and 3, this is the fun part, you take the standard deduction and you simply grant $6,000 per year out of your DAF to your charities. They receive their gift right on schedule. Nothing changes for them, right? The result? Same total giving, same impact, but actually you may have saved $2,000 to $4,000 in taxes in a year 1 just by timing it differently. And again, here are a few more things you should know about the donor-advised funds, okay? You can invest the money inside your DAF and it grows tax-free, right? And while you decide where to grant, some people build significant balances over years, of course, because you maybe haven't figured out where you want to give it to or who you want to give it to. But this way, actually, you can contribute cash, appreciated stock, or even other assets like real estate. Now, grants from a DAF can be made anonymously if you prefer. I know a lot of my clients donate that way. They really like it that way. Nobody has to know their business. I agree. It's fine. Do it quietly. And some actually DAFs allow you to name a successor, making it a multi-generational giving vehicle for your family. So it certainly makes sense. A donor-advised fund also actually is not just for the ultra-wealthy. I've helped clients open DAFs with as little as $5,000. Now, the technology and accessibility have improved dramatically in recent years. And if you give more than a few $1,000s a year, this is definitely worth looking into. Seriously. And basically, I'm just going to touch on tax basics. I mean, it just makes sense since we're talking about this, right? Well, now let's talk about the taxes for a few minutes, because understanding actually the tax side is what separates a good donor from a strategic one. Makes all the difference. 3 things you need to know. 3. Simple. Number 1, the standard deduction versus itemizing it. I'm talking about 2024, but in 2024, the standard deduction is $14,600 if you're single, obviously, and $29,200 if you are married, filing jointly. Very important. Naturally. If your total deductions don't exceed that number, charitable cash donations do not reduce your taxes at all. Please remember that. Number 2, AGI limits. Cash donations are actually deductible up to 60% of your adjusted gross income. Donations of appreciated assets are capped at 30%. That's it, 30%. If you exceed those limits, you can actually carry the excess forward for up to 5 years. That's a freaking great thing. It really is. Number 3, bunching strategy, which I just walked you through with the DAF, okay? Basically, what do? You stack 2 or 3 years of giving into 1 year, itemize that year, and take the standard deduction in the off years. DAF makes this completely seamless, so you can certainly do that. Some of you already probably bitching about it, but Milan, you didn't talk about the advanced tax strategies. Snap out of it. I'm going to talk about it, so just pay attention, okay? Basically, we are going to talk about it because, look, stick with me for the next few minutes. Why? Because what I'm about to cover is rarely discussed outside of a high net worth financial planning circles, basically. And these concepts apply to anyone actually who is building wealth. And knowing they exist means you can grow into them. Makes kind of sense, doesn't it? For example, the first thing we're going to talk about is charitable remainder trust. Let's start with the charitable remainder trust, or CRT as we said it, right? CRT. Now, you got to remember this, how it works. Your transfer appreciated assets, often like a real estate or stock, into an irrevocable trust. Keyword there, irrevocable trust, remember that? The trust sells the asset with no immediate capital gains tax, reinvests the full proceeds, and then pays you or a named beneficiary an income stream for either of your lifetimes, or is actually set for a number of years. How about that? At the end of the trust term, the remaining assets, that's the 2 keywords, go to the charity you designated. You're welcome. Hugs and kisses later. You also receive a partial charitable deduction in the year you fund the trust. For example, is a real world example. Imagine actually you own a rental property, right? You purchased it for $80,000. That is now worth $500,000, $500,000. If you sell it outright, you could owe basically $80,000 or more in a capital gains and depreciation recapture taxes, basically. But if you fund a charitable remainder trust with that property, that's the key. The trust sells it tax-free, reinvests the full $500,000 and begins paying you income. Hello? You receive more income than you would have after taxes. The charity receives a meaningful future gift, obviously, and you avoided a massive tax bill on the sale. You're welcome, okay? You're welcome. Thank you. Another thing, advanced one, okay? The charitable lead trust works in reverse. The charity receives income for a set number of years, okay? And then your heirs actually receive the remaining assets. This is actually a powerful estate planning tool because it can significantly reduce your gift and estate taxes while you're supporting a cause you care passionately about at the same time. So there's another way to do it, okay? Another one of the advanced techniques actually, it's called a private foundation versus the donor-advised funds. One question I actually get from a high net worth clients, not everybody of course, should I start a private foundation instead of using a DAF? We are talking about folks, private foundation starts to make sense when your annual giving basically approaches $1 million or more. When you want a maximum control over how grants are made, or basically when you want to employ family members in meaningful philanthropic role. People who have won Powerball, Mega Millions, some of them actually have done that. But there are also actually a real downside as well. Significant actual administrative costs, IRS compliance requirements, because you have to comply with the rule and regulatory thing. A mandatory 5% annual distribution, so no matter how much money you have to distribute at least 5% annually, which a lot of these rich people forget, I think. And excise taxes on investment income. For most people, a donor-advised fund provides 90% of the same benefits, right? With a fraction of the complexity and no minimum distribution requirement either. Makes sense, right? Next one we're going to talk about just briefly and talk about it. It's the business owners, if you're a business owner. A quick note for the business owners. Under the IRS, Section 170 that I touched on briefly earlier, businesses actually can donate inventory, whatever that is, and potentially deducted at an amount above cost basis with a special rule for food donations and certain other goods. For example, C corporations can deduct up to 25% of taxable income for charitable contributions. Donating services generally is not deductible, unfortunately. but the actual expenses you incur in providing those services may be. So if you drive, fly, whatever you have to do, you can deduct that, obviously. Now, naturally, I'm going to say this, I always work with your CPA, so for CPA, what do you call accountant, so for planner, accountant, on a business giving strategies. The rules are specific, but the opportunities are real, they really exist, and you should definitely benefit from it. Giving without money, this part is. Basically, I want to stop for a moment and just speak directly to someone watching this who's thinking, hey, this is ridiculous, this is great, but I'm not in a position to donate right now. I hear you, I get it. Maybe you're paying off your debt, maybe you are rebuilding after a tough year, maybe you're basically early in your career and every dollar counts. We know that, we all been there, okay? I understand. I hear you, okay? And here's what I want you to know. And this is the truth, because I've done it, as I mentioned earlier. The most valuable thing you can give actually isn't always the money. That's the God's honest truth, it really is. Your time, your knowledge, and your presence in someone's life can change a trajectory in a way that a check never could actually. Yeah, if you can write a check, great, but if you can participate in somebody's life, a whole different ball of wax. Let me show you exactly how to do that, okay? First, the numbers. Volunteer actually labor contributed to nonprofits in the US is estimated to be worth about $300 billion annually, just the labor volunteering comparing to. That is comparable to the entire cash donation economy almost. Remember we said it was a $500 billion that's donated annually? A skilled volunteer, a lawyer, accountant, IT professional, financial advisor, or is worth $150 to $300 per hour to the nonprofit that couldn't otherwise afford those services. So why should they write me a check when I can go and volunteer and help, right? So where do you find these opportunities? It's the next question. It's logical, I agree. Volunteermatch.org, I think it's the largest volunteer matching platform in the country, so volunteermatch.org. You enter your zip code and your skills, and you browse hundreds of local opportunities, basically. Idealist.org is particularly strong for professional and skills-based volunteering. Somebody who obviously has a specific set of skills. Naturally, also, you probably heard of it, your local United Way chapter coordinates also volunteers across dozens of nonprofits in your community. So not just from one, from different sources as well, which is pretty cool. Local food banks and meal programs almost always need hands, especially on evenings and weekends when the food is handed out. They need labor, they need people to help people get food, obviously. Habitat for Humanity is great for anyone who actually wants physical, hands-on community work. I have a ton of clients who've done it and I enjoy every minute of it, okay? And don't overlook your own faith community, often the most direct path to a meaningful local impact. So if you have a church or synagogue you belong to or any of the worshiping places, you can certainly make a difference there. Now, I want to make a special ask for anyone watching this who has a financial knowledge. If you made it this far in the video, yeah, thanks for being patient and being kind to me. You clearly actually care about the financial education. That's what this challenge is all about. And I want to challenge you. Take what you know and go teach it to someone who needs it, someone who can use it. You don't have to be a certified financial freaking planner. You just have to know more than the person in the room. Isn't it the same for the YouTube? That's what they say, right? The NFEC, the National Financial Educators Council, has a volunteer curriculum you can use at no cost, okay? Also, there is a Junior Achievement runs financial literacy program in K-12 schools and needs adult volunteers to lead classroom sessions. Why is this thing not taught in school? God, I have so many questions about that. We'll talk about it in one of the videos. Your local library. Most branches will host a free financial workshops if you simply propose one. How do I know? Ask me. Call the branch manager and offer an hour of your time. Duh. SCORE, a nonprofit supported by the Small Business Administration. I subscribe to the email daily. I get stuff daily to go on webinars and whatnot in my area as well, if there is a real seminars as well. Pairs experienced professionals with small business owners who need mentoring. It's free to participate and the impact is real. I can confirm that, definitely. And if you want to start even smaller, platforms like Kiva.org let you make microloans to entrepreneurs around the world, starting at just $25. When your loan is repaid, you relend it to someone else. Your money works over and over. How cool is that? I love that. DonorsChoose.org lets you fund specific classroom projects proposed by the public schools, teachers, pencils, science kits, books, and you see exactly what your money buys, actually. You can actually literally see. The bottom line is this. There is no version of I cannot give. It doesn't exist. There is always something you can do, and often the people who actually give their time and expertise basically create more lasting change than any check ever written. I can confirm that without any doubt. I cannot stress how important that is, folks. Seriously. Action plan. Here's your step-by-step action plan, okay? Now, whether you have a $50, as they say, or 50,000 or 500,000 to give this year, follow these steps and you will be giving smarter by the end of this week, I hope. Step 1, clarify your why. Why are you doing this? Pick your cause and write it down. Hunger, education, faith, environment, community. Giving actually with intention creates more impact and more personal fulfillment. That's a fact. Step 2, vet your charities. Check them out, of course. Use Charity Navigator, Give Well, or IRS tax exempt organization search. Look for overhead ratios under 25% and transparent financials. The more you know, the better it is. Step 3, audit your financial situation. Do you itemize? Do you hold appreciated stock or real estate? Are you over 70 and a half with an IRA, or 73 now basically? Or your tax situation determines your best giving vehicle. That's obvious. Step 4, choose your giving method. Match the method to your assets and your goals. Whatever you have, you can do. Cash, obviously, for simplicity. Stock for tax efficiency. A DAF for flexibility and bunching. QCD for retirees. Your time and expertise for direct community impact. I like that one. Number 5, set a giving budget. 1 to 10% of income is a common financial planning benchmark. So even $25 a month adds up to $300 a year. Automate it. So it becomes a habit, not a decision. You have to make under pressure in December. Nobody's asking you to do so. Number 6, consider volunteering your expertise. Contact a local nonprofit, score, junior achievement, and a food bank. Offer to teach a workshop, mentor a family, or help with their finances. Makes sense, right? Step 7, document everything. It makes a lot of sense. Save all receipts. It makes a lot of sense, as advice I can tell you. Get written acknowledgement letters for any gifts over $250. Keep a mileage log for charity driving. The IRS requires documentation to claim deductions. Obviously, you have to prove it. Step 8, review annually with your financial advisor. A year-end giving review can reveal new opportunities and optimize your strategy as your income and assets change each year, because it will be different. Step 9, talk to your advisor before December 28th, not the 31st. Stock transfers and wire transactions take time, and it actually might be 3 to 5 business days. So if you wait until December 31st, your gift might not clear in time to count it for this tax year. So very, very important, okay? So this is important, obviously. We want to talk about it. Basically, 5 mistakes to avoid. So before I let you go, basically, I just wanted to make sure you don't walk away and immediately make one of these 5 costly mistakes. I have seen every single one of these in a real client situations, really have. Mistake number 1, donating cash when you own appreciated stock. Really? Snap out of it? This is single most expensive mistake charitable investors make. If you own a stock with an unrealized gain and you're writing checks to charities, stop, for the love of God, please. Donate the stock directly. The tax savings are significant, and it takes about 10 minutes to set it up. It's that easy. It really is that simple. Mistake number 2, not getting written acknowledgement. So for any donations of $250 or more, the IRS requires, the keyword, contemporaneous written acknowledgement, basically from the charity, acknowledging that you have done that before you file your return. Without it, basically deduction can be entirely disallowed at audit, even if you absolutely made the gift. Every reputable charity will send this automatically, but make sure you have it on a file before April, or basically 15 before you file your taxes. Okay, makes sense. Mistake number 3, giving to unverified charities after disasters. Boy, we live in Florida, I can tell you, every year there's some scam going on. So scam organizations, multiple after hurricanes, we know that down here, that's a fact. Wildfires and other disasters. Always verify charity on a Charity Navigator or Give Well before donating in the aftermath of a news event, just because they saw the news, okay? If you want to give immediately and don't have time to vet, use an established national organization like American Red Cross or your local community foundation. There's got to be one, okay? Mistake number 4, waiting until December 31st. Duh, why? Makes no sense, okay? If you're gonna give before. Stock transfers to charities or donor advised funds can take 3 to 5 business days to process. It really does. Your real year-end deadline for non-cash gifts typically is December 26th or 27th. Mark your calendar now. So I would definitely do it even before then. If you can do it throughout the year or beforehand, I would definitely do so. Mistake number 5, giving from the wrong account. Oh boy, I've seen that before. Never taken what we call early IRA distribution to fund a donation if you're under 59.5. You will own income tax, obviously, and a 10% early withdrawal tax, penalty tax. Now, so never donate directly from a 401k while you are still employed. Use your taxable investment accounts or your advisors here at DAF, favorite for charitable giving. The one exception, of course, which we covered earlier is the QCD, strategy for holders of 73.5. So if you're a little bit older, you can certainly do so, okay? Very important. So basically, in closing, I just want to say this. Charitable giving actually is one of the few places in financial planning where doing the right thing and the smart thing actually are exactly the same. I kind of like that. The IRS obviously rewards the generosity. Duh. Communities are strengthened by it. Duh. And you own a sense of meaning and purpose grows with it. Basically, what you're doing, it's the right thing. Now, whether you start this week with a $25 gift to Kiva loan, are now volunteering, I've done it many times, or a call to your financial advisor about donating appreciated stock, start somewhere, start anyway, okay? Download the free checklist in the description. I obviously will include that. Share this video with someone actually you know who gives to charity every year. Those people are special and it should be also recognized. I hope this helps them do it the right way and the smart way, as we said at the beginning. And if this was actually helpful, please subscribe. I cover financial planning topics like this every single week. Again, my name is Milan, and we do come here to Financial Wisdom with Milan for a reason. Thank you for watching, and I'll see you in the next one.